Over the last couple of years, the financial landscape has seen a tectonic shift. I mean, the line between Wall Street trading and outright gambling hasn't just blurred, it has completely vanished. Welcome to today's Explainer, where we're going to unpack the sudden, multi-billion-dollar explosion of prediction markets. Let's dive right in, because these aren't hypotheticals. These are actual, real-world wagers you can place right now on platforms like Polymarket and Kalshi. You heard that correctly. You can literally bet real money on everything from religious prophecies and celebrity dating lives to major political disclosures and even the late-night social media habits of billionaires. We're looking at the Wild West of modern finance, and it's all accessible with just a few taps on your screen. To make sense of this chaotic trend, here is our roadmap for today. We'll cover the prediction market boom, how event contracts work, the legal loophole making it possible, the wisdom of the crowds, the casino reality, and our final verdict. Starting off with Section 1, the prediction market boom and the rise of platforms like Polymarket and Kalshi. You know, to a lot of people, these platforms feel like glorified casinos, but the executives running them, they argue they're offering crucial prediction data and a way to hedge financial risks. To understand what's actually happening, we really have to look at the baseline instrument driving the whole craze. It's called an event contract. With this, you aren't buying a piece of a company like a traditional stock. You're buying a simple yes or no. It's a strictly binary, all-or-nothing wager on reality itself. Let's move to Section 2, how event contracts work, to really break down the mechanics of the trade. So, what is the actual life cycle of your money in this new ecosystem? Well, first, you buy a contract based on how you predict an event will unfold. Second, you watch the price of that contract fluctuate in real time as news breaks and the odds inevitably shift. Now, you can cash out early to lock in a profit or stop a loss, but if you hold until the event actually triggers, the result is final. You either earn a fixed return or you lose absolutely everything. And that brings us to a massively underdiscussed risk, the asymmetric downside. You might see a viral video popping off on social media saying, hey look, the news says a specific file is going to be released on Friday. Buy the yes contract for an easy 10% gain. But what they conveniently leave out is that to chase that tiny 10% profit, you're risking 100% of your principal. It literally only takes one sure thing failing to completely wipe out weeks of your steady, small gains. Which brings us to Section 3, the legal loophole, and how exactly they bypass the rules. You're probably wondering, if betting on an election or a weather event feels exactly like gambling, why isn't it regulated like a casino? Well, platforms like Kalshi pulled off a brilliant legal maneuver. By classifying these bets as financial derivatives, akin to trading wheat or oil futures, they successfully argued that they actually fall under the jurisdiction of the Federal Commodity Futures Trading Commission, or the CFTC. A judge ruled in their favor, stating that betting on things like elections didn't constitute traditional gaming. So, by operating as a derivatives exchange rather than a bookmaker, they completely bypassed strict state-by-state gambling laws. Let's look at the other side of the coin in Section 4, wisdom of the crowds, which is actually a very valid argument. We have to impartially report on why serious economists and political scientists are just so fascinated by this technology. Check out this staggering data point. Over a 2-decade period, the decentralized betting of the Iowa electronic market beat out professional forecasters 74% of the time. Just think about that. When thousands of people put their own hard-earned money on the line, the collective wisdom of the crowd ruthlessly cuts through personal bias and media narratives to surface incredibly accurate forecasts. And beyond just providing forecasting data, these markets theoretically act as genuine financial insurance. Imagine you're a shipping company that relies heavily on imports. You could buy an event contract that pays out if a specific tariff is enacted. If that tariff happens, sure, your core business suffers, but your prediction market payout offsets the loss, acting as a direct hedge. So, in theory, this is a highly sophisticated, net good financial tool. But let's shift gears to Section 5, the casino reality, and look at the social media scams and illusions. Because while the theory of prediction markets is entirely sound, the reality of how they're marketed to everyday retail investors is honestly pretty alarming. TikTok influencers are out there aggressively pitching these platforms as guaranteed money printers. They sell this illusion that you have an edge just because you read a CNN headline about defense spending or a court document. But listen, unless you have a nanosecond trading advantage or literal insider information, you have no edge. The the market is incredibly efficient. By the time you read that news article, thousands of other traders and their trading bots have already priced it in. And if you think copy trading the top accounts is some sort of cheat code to get around this, think again. These are often extremely thinly traded markets. By the time you and hundreds of other followers blindly mirror a top trader's bet, the crowd has already bid the price up to a massive premium. Then, when that influencer inevitably cashes out, the mass sell-off crashes the price, leaving you holding the bag at a steep loss. Oh, and what about those secret developer skip codes you see floating around on social media? Yeah, they aren't hacks. They are highly lucrative referral schemes. Influencers fabricate a false sense of exclusivity and urgency, claiming there's a massive waitlist just to get onto the platform. Why? Because they earn a commission on your trades. The relentless marketing machine driving these platforms relies heavily on getting inexperienced users to just churn through fees. So, despite the sophisticated packaging of derivatives, the harsh reality is that most everyday users end up losing money. While platforms defend themselves in court as essential financial exchanges, their aggressive advertising perfectly mirrors a casino, directly targeting a young demographic with the allure of quick wealth. Add in the rampant risk of trading against individuals with literal insider information on highly niche, unregulated events, and the data tells a very familiar story. This functions exactly like high-risk day trading. Finally, let's wrap this up with Section 6, the final verdict, navigating the gamification of finance. Look, prediction markets are not inherently evil. They simply represent the ultimate, logical extreme of gamifying our financial ecosystem. These platforms offer fascinating, unparalleled data and real hedging capabilities. But as the line between investing and gambling completely vanishes, you have to ask yourself one question. In an ecosystem gamified by influencers, referral codes, and legal loopholes, are you the savvy investor spotting a trend, or are you just the casino's newest patron?